Welcome to another Realestate.com.kh TV news report. Today we're going to talk a little bit about property tax, and we're speaking with CEO of Cambodia Investment Management, Mr. Anthony Galliano.
Thank you for having me.
No problem, a pleasure. Now, for people buying property in Cambodia, there's a few hidden costs that you may or may not know about. So we're going to learn a little bit more about Cambodian property tax from Anthony.
Okay. We're going to talk today about three basic taxes that you should be aware of. One is as an owner, and not necessarily only as an owner, as perhaps a possessor of property or a beneficiary of property. There is a liability potentially for tax. But let's say as the owner of a property, what they call in the tax office as immovable property, there is an annual tax that's due on your property that you should be aware of. If you're buying or selling property, there's a transfer tax which you should be aware of as well. And of course, if you're renting property, you should be aware of that as well, which is a withholding tax on rental. So
if
those
you're
are the
landlord.
If you're, we'll get into the technicalities, but basically on a rental contract, whether actually it's a house or a villa or a condominium or even a car or a generator machine, anything you're renting, there is a withholding tax on rental of property. Okay. So we'll get into the main tax, which is the property tax. So if you own a property can be considered a condominium. It can be considered land itself. It could be considered just an apartment. If you own any property which is called immovable property, you're supposed to pay a tax annually by September 30th. Okay. Now the calculation of the tax is quite interesting. It's based on your location, obviously. It's also based on the type of materials possibly used in the building. It could be concrete or non-concrete, could be wood. So that plays a factor into the valuation of the property, what they call the tax base of the property. It could also be based on data collected. So the government has collected data to get an idea of what that tax base should be. So there is some thought behind the tax base of a property. There are exemptions to what's taxed. Obviously, there's always exemptions. Agricultural land is an example.
Tax-free.
It's tax-free. Also, state land, of course. The state doesn't tax itself in this case. And some locations on economic zones, industrial locations, for instance.
Special exemptions.
Yes, would be special exemption. But as a condominium owner or a villa owner or a house owner, you have to pay property tax if the value is over $25,000. That's where we start. We start with a value of $25,000.
Foreigner or local? Same.
Yes, owners of property.
Same tax.
Yes. So the owner of a property basically is required to register that property. They will get a what's called a PTIN, a property tax number. Now we know also what we see how important this has become because those that are trying to register companies, one of the requirements by the tax office is to produce that property tax receipt. So you may have trouble registering company if you're a landlord, for instance. If you're renting an office and they don't provide a property tax receipt, then this, of course, the tax department will ask for that as on the basis of registration documents. So it's very important to, obviously, for those renting offices to make sure their landlord is paying tax. Okay, but the basis goes again. It's $25,000, and the valuation of as we said, is collected through various means, but there is a mechanism that the government actually creates that tax base. And I'm going to look at my little notes here to make sure I get it right. It's a real estate evaluation commission, and then a property valuation committee, as part of the government, values the property.
So the government values.
Yeah, there's a tax base that the government creates. So your tax base is where you start for the value of the property. If the property is under $25,000, no worries, no tax. If it's over $25,000, there's an application of tax on the land itself and in the building on the land. So if the owners are different in terms of owning the land and the actual building itself is owned by somebody else, the landowner pays his property tax and the building owner pays their property tax. You look confused, but it's the way it works. Yeah. I mean, it's two separate ownerships, so there should be two separate taxes. Okay, so the basis is 0.1% of the tax base, and how it's calculated is basically, I'll make it very simple. If it's the property is $100, you start with 80% of that. Well, that's going to be a bad example because then you have to subtract $25,000. So you start with 80% of the value of the property, you subtract $25,000 from that because that's the exemption. Consider it a deduction, and then you multiply by 0.1%. And that's as simple as it is. That's your property tax.
Okay.
And you have to file that by September 30th every year and pay it at your tax department, your tax branch.
So this might be something that pure investors, people who are buying condos from overseas, aren't aware of.
Yes, I mean it's been more strictly enforced over the last 3 years. The government's been kind of generous, in fact, to those that have low income side, let's say, because the $25,000 threshold, and I'm not sure with the property boom if there's much $25,000 apartments out there anymore, but those that own $25,000 apartments don't have to
Pay any tax at all.
But I mean, if you look at those that own $50,000 apartments, let's say, you just take 80% of the $50,000, you subtract the $25,000 exemption, 0.1%, then you're looking at pennies, right?
Yeah.
So it really starts coming into effect when you're really for those on the wealthier side that own significant valued properties.
Mm-hmm.
Those that own a couple $100,000 condominiums or houses, it's a very immaterial amount of money.
But still, for these investors, they'll need to consider an asset manager or someone to pay attention to these things.
Sure.
And if they don't pay, what happens?
There's penalties. Absolutely, there's penalties. You have to pay. And as I said, if you're renting, or especially if you have offices you're renting, it's now become really a requirement to produce the property tax certificate that you've paid. Okay. So that's one tax. Especially for your investors, there's a transfer tax. When you transfer the registration, that's 4%. So that's something to be aware of.
4% of the total value of the property?
Yeah, it's 4% transfer tax, yes. And the other tax to be aware of is, as a rental, if you're renting, is a withholding tax. So let's say you're a business and you're renting an office. You have to pay 10% withholding tax on the rent. Now, the landlord you're supposed to withhold that tax if you're a business, and you're the withholding agent effectively, and you pay that on your tax return. But there is a 10% on, it's a basic tax, there's a 10% rental tax if you're renting a property.
Okay, Anthony, thank you very much for,
It's been my pleasure, James.
teaching us a few things. And thank you to all of our viewers. Tune in to Realestate.com.kh TV next week for more great information for buying your next property.